Welcome to the second module of this e-learning series on financial modeling for public-private partnerships brought to you by the World Bank and DFID. In the previous module, we focused on some financial analysis techniques for public-private partnerships. It's important to remind you that this mode of teaching is a participatory one. That means that you will be learning from the experience and knowledge of other learners such as yourself. Let's begin now by looking at risk identification and appraisal techniques for public-private partnerships. So, one of the things we learned is financial analysis is what kind of model do we have? What are we examining in our financial model? What are some of the key concepts, key indicators? Okay, yeah.
We are looking how much revenue do you require from the financial?
I'm sorry?
How much revenue do you require?
How much revenue is required? More, and as important as revenue is going to be our top line, right? We're going to, as you see, as we build up the model, we'll look at expenses and everything, but what's the bottom line? What do we have at the bottom of that financial model? We have revenue at the top, that's the money coming in. We got to pay for things, including our debt. But what are we going to have at the bottom? What's that? Profit. Hopefully profit. Cash flow, right? We're going to have cash flow. Okay, so if we have cash flows over time, what are some of the things we want to take a look at? What do we want to examine to see if a project is going to be feasible, financially feasible? So we have our cash flows. Yes. Owen, if you could stand up, if you don't mind. Sorry. We just want to put you on film.
Okay. We will have to see if how long the project will be paid off. I mean, what you have injected, when will be paid off, and the NPV, IRR, if the project is feasible or not.
Okay. And what does that NPV stand for?
Net present value.
And IRR?
Internal rate of return.
Right. So net present value, if a project's feasible, the net present value is what? Negative or positive? Right. Internal rate of return is what?
The internal rate of return is discount rate which produces the NPV which is equal to 0.
Well, but if the project's feasible, it's going to be what in relation to the discount rate, the internal rate of return? Oh. Should be larger, should be greater than the discount rate, right? So that means that essentially the investor is now going to be making a profit, or is going to be making a return on their investment sufficient to satisfy their needs, is what's going to happen. One last review concept. In our financial analysis, our model, and these are things we're going to build on during this week. The model will show us all these things. It will show us NPV, it'll show us IRR, we got cash flows, we'll have different things in there. But what are we trying to balance by using this model? What are two of the concepts, big concepts in public-private partnerships, right? Yes, yes.
We want to see if the project can be bankable.
Bankable?
Yes.
And?
Also, we want to make it to see the requirements in the projects.
Well, close. Bankable's half the answer. Bankable means, right, that the private party can make enough return on their investment as well as generate enough cash flow to support the debt. But what else? So that's good for the private party. What about for the public or the government? What do we need the project to be? Okay, bankable is good for the private.
So yesterday I was having some confusion.
Okay.
I was trying to review, the interest rate, the bank lending, the lending interest rate.
Yes.
And the discount rate. So we need to know the relationship between.
Oh, between the discount rate and the bank lending rate?
Yes.
So two different things. The discount rate is used to calculate net present value, and what the discount rate is reflecting is And the discount rate is sometimes in the eye of the beholder who's using the discount rate. So if you're in the private sector, and by the way, if you're doing your financial analysis, you should probably be using the private sector's discount rate to see if it's going to be bankable for them, it's going to reflect what they consider to be the risk of the project. And that risk, and that's going to be the topic of this morning's session, those risks can involve a lot of different things. You know, things that are totally out of their control, such as inflation, and things that are somewhat within their control, demand. Okay, so that's going to be factored into that. All right, the borrowing rate, the interest rate for, say, a loan, is the bank. It also reflects what the bank considers the risk of the project. But it's basically, for the bank, it's what they need to get back to make a profit on their loan that also is risk adjusted. So if they consider the project to be riskier, the interest rate will be higher. Similarly with a discount rate, if the investor thinks the project's risky, they will increase the discount rate. All right?
I just want to know, because when we were doing our pre-feasibility study, we have seen they've considered the discount rate is 12%. And what they've said that it is a benchmark from the World Bank. So who's setting the discount rate? Is it the World Bank or is it from the Bank of Tanzania?
I don't think there's a hard and fast rule of what the discount rate is. Each project is unique. And I would argue that you have to put some real thought into, and this is where you get a lot of this from your transaction advisors who see a lot of different projects. And you come up with the appropriate discount rate for the individual project within the individual economy and everything else that's going on and the risk associated with the project.
Can you elaborate more on Project RR and RR on equity?
The internal rate of return, what is that?
Project RR and RR on equity.
Okay, so yeah, so there's no real, the project internal rate of return and the return on equity, the rate of return on equity, that's what you wanted, the differences or similarities? Okay, so if you recall, the internal rate of return is that rate where the net present value equals 0, okay? So it's, mathematically, that's essentially what happens. The rate of return, it's very similar to the rate of return on equity. They're almost indistinguishable. Right now I'm having difficulty figuring out the exact difference, but if you invest $15 million, right? That means in year 0, you have $15 million of cash flow going out. It's going out, it's negative. Then from our example yesterday, from our exercise, let's say for the next 15 years, you earn $3 million each year, cash flow, boom, 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 boom. Well, what the internal rate of return does, it looks at all those discounted cash flows, all those out years against the money you invested, the 15 million, hence why it's called not simply present value, it's net present value, because we subtract out that 15 million. And then looking at that over the course, in this case, 15 years, discounted back, if I had put $15 million in, which is my equity, what is the rate of return on that if I'm going to get $3 million a year for the next 15 years?
When you are mentioning a project means covering the equity plus debt. But equity is only equity. Now, when we are saying the internal rate basing on one item, and then when we're talking about the project, we are covering the entire, meaning debt plus equity. When you invest, there is equity inside, but there is again a debt on it. And there is ratio. It can be 50-50 or can be 70-30, whatever, depending on the nature of that project. That we're trying to put forward, maybe to have the clarity of understanding, if I'm not wrong anyway.
So what you just described in terms of a project is, let's say we have a project that's worth 100 million US dollars. And we have 20 million of equity as part of it. We have 80 million of debt, a loan or loans, okay? Oftentimes you'll hear the phrase that this is referred to as the capital stack, right? This is what goes in to fund the project, all right? And these things are financing, okay? Just again, as part of our review, which one has a lower interest, the equity or the debt? Okay, who thinks the debt has a lower interest than what the equity might have? Okay, who thinks the debt may have a lower interest? Okay, right. Why is the debt interest rate lower than the required rate of return for the equity?
Because the equity is more risky than the debt.
Yeah, you violated Ned's rule. What he said was that the debt has less risk, and it has less risk because they're going to get paid before the equity does. So less risk, lower interest rate, okay? The other thing you find, and you'll see this again over the course of the week when you start working with your financial models, is that if we can use less of our money, if we have to use fewer shillings, our cash, our equity, and we can borrow more money, do you think our returns on equity will go up or go down? One of the phrases Ned used, he calls this OPM, other people's money. This is the bank's money. This is the lender's money. If I have to use less of my money intuitively, and I'm making profits, well, I'm actually probably going to have, all things being equal, I'm going to have a higher rate of return on my equity. So if I don't have to put any money in, if I put zero in, if I can borrow 100% for the project, I use the bank. The bank's going to pay for everything. All I got to do is make sure I make my interest, my principal and interest payments to the bank, my debt service. And the project makes money. Well, I'm making lots of profit, right? I didn't put any of my own cash at risk. That's a pretty good return, right? If I don't have to reach into my pocket, and I can start a project, I can have a public-private partnership to build a school, and I can borrow 100% of what we talked, the capital stack. I can get the bank to put all the money in. I don't have to put any cash in. And the government's going to make an availability payment. And I perform, I do my job, and I make a net cash flow after paying the expenses, paying the debt service. Wow, I'm making a lot of money and I have nothing at risk. That's a great day from the private sector perspective. One of the things you will also learn, Ned covered this, and you'll see it more in action. Well, it's difficult to borrow 100%, part of it's risk, but also we have something called the debt service coverage ratio. The bank, they want to be protected. They're worried about their money, so they're not going to they want to make sure you have enough, they want to make sure the private party has enough cash flow to not just make their debt service, but there's a cushion, that there's a safety buffer, that there's always going to be enough money to do that. So when we'll see all this illustrated and repeatedly, a lot of it through our exercises, when you're manipulating your cash flow models. The last thing I'll say, unless there's other questions, when you did a really good job yesterday in terms of putting in the exercise, working with your cash flows. That's a real critical skill in financial analysis. And you can just keep building on it, layering into it. And I really enjoy it. It could be a little nerdy, but it's kind of fun to kind of see how these things work and where you can take it.
My question is still rely on the doctor's question on a case of interest rate and discounting. Yep, discounting factor that we have already done yesterday on calculations. I've gotten something that's cracked my head when we talk about these two things. Because when you take maybe 12%, that means this maybe discounting factor. Is that reflect a 12% the same as the interest rate? The second question is about an internal rate of return. We see the internal rate of return yesterday is about 17 point something. So if this internal rate of return has to be greater than the interest rate to make sure that the project is viable. And the last one is about when we discussed here, I see you said that this internal rate of return has to be, if I don't mistaken, larger compared to the NPV. Maybe can you make me a clarification on this?
Okay, so let me take the last question first. So the internal rate of return in terms of being larger than the NPV, they're related but two different concepts. So the NPV is arrived at with a discount rate, okay? A discount rate. So which is a percentage. The internal rate of return is also a percentage. For the project to be viable, it means that the internal rate of return is greater than the discount rate. It might be 0.1%, but it's equal to or greater than the discount rate. Otherwise, you know, if your discount rate is, let's say, 12%, and your internal rate of return is 11%, well, what's happening is, even though the project might be having what we call positive cash flow, it's not losing money year in, year out, but in real terms, in terms of your investment, remember, let's step back for a second and think about this when this gets back to being PPP professionals. When you're trying to attract a company or firms to invest in a project, into a public-private partnership project, what are those companies doing? They're making decisions. They're looking at investments sometimes around the world. They have choices where they can go with their money. And simply because a project might have positive cash flow, in the case of the example we just used, so it might have positive cash flow. It's not going to, year in, year out, have negative cash flow. It's actually going to have positive cash flow. The problem is, if let's say the discount rate is 12% for that company, that's what they require the project to make and for them to, the profit that they want to achieve. But if it's making only 11% in terms of an internal rate of return, that means they're actually losing money. If they had a choice to invest their money elsewhere, that would be a better investment than this one, because here it's underperforming, right? So that's kind of the critical concept. That's why I say the discount rate, you know, you can set an arbitrary thing saying, okay, we're going to examine everything with a discount rate of 12%. You could do that. But what it really comes down to is, what does the individual investor think the discount rate is, because that reflects what they require in terms of making a decision to invest, okay? Your other question concerning the bank loan and the interest rate that the bank charges, okay? That's going to definitely impact the internal rate of return. It's going to impact the net present value. The reason it's going to impact it is if we look at, very, very simply, if we look at our cash flow model we have revenue. That's the money the project earns, right? We have what we call operating expenses, OpEx. That's what we need to spend to operate the project. We have to pay for labor, might have to pay for utilities, insurance, materials, maintenance, all right? That's what it costs to operate the project. That's a negative. We have debt service, DS, debt service. That's our loan. We got to make those payments, right? And we do all that, we have cash flow. That's the money that we're going to make on the project or lose on the project. Well, one of the things that influences operating expenses is, say, inflation. You know, we're going to have our years, 1, 2, 3, maybe out to 30 years. Well, I might do a decent job of predicting what inflation is going to be in year 1. Really difficult for anybody to tell me what inflation is going to be in year 15. Really, not, did I say really difficult? How about impossible? Okay? So it's hard to predict. So when we put in our discount, when we come up with our discount rate, we're going to have to reflect what inflation might be and the risk of inflation increasing. That goes into the discount rate. But it's going to, you know, what our rate of inflation is going to impact cash flow. If inflation goes up, our operating expenses are going to go up. All right? Debt service. Well, the big impact on debt service is what is the interest rate that the lender is going to charge. Okay? Is it going to be high? Is it going to be low? That interest rate will reflect risk. Okay? And the interest rate, and let's say there is no risk that the interest rate changes for the bank loan. It's going to be steady throughout. Well, we know what our loan payments are going to be each year. But depending on that, whatever that is, that's going to impact cash flow. Okay? So if the interest rate is high, our cash flow will be less. If the interest rate is low, our cash flow will be higher. Well, we have our cash flows down here, and you're going to calculate net present value, and you're going to calculate IRR. Well, if our cash flows are high, net present value is higher. If they're low, NPV is lower, same goes with IRR. So the interest rate for the bank loan impacts cash flows, which impacts NPV, which impacts IRR. Pretty much that straightforward. Other questions or comments? These are really thoughtful.
To complement from what Ned has been saying, that actually when you're talking about discount rate, we are trying to think of the value. Let's say, for example, somebody brings his money, equity, and he wants to invest. So he tried to consider, I'm investing this money, which maybe the return of this will take maybe 5 years. So I need to discount to see my value, which will be taking maybe 5 years. For now, how much it is. So that the value of that money is going to be discounted by that rate. That now, my value, equity value, is going to be discounted by this rate. So let's say, for example, a project cost. A project cost is more than that equity. Equity is just a cash. Then we want to talk about the project cost. It means it includes other costs like debt and other costs which may be incurred during the project. So that one also, you need to value it, to see its value. This is going to take you for 50 years, for 15 years. I need to discount to see that value in present, how it can look like. What do I say that this is my value? So when you're talking about the rates, for example, in BOT, the BOT has provided the discount rate for banks to borrow money to the BOT, that you're going to give you money so that you're going to use it to rent the people. So the BOT provides the bank, provide the money to the other commercial banks in a rate, for example, of 9%. It has value his money, which is going to give the commercial banks to lend the people. So that rate which is providing is the value of the money for the bank, for the BOT, which is going to give the commercial banks maybe for 5 years. That we are going to give you this 50 millions, but we value this in this. You are going to give us a rate, for example, of 9%, which will value us in those 5 years, which you're going to stay with the money. For this present, this value is this one. So when you try to consider the equity and the BOT, equity, we are considering that what you had said by the Makaranga, that is the total amount of the project. You are consider the value of the total project, that this total project has got a value of maybe of 50 billions. So if I need to know his value in presence, I need to discount it. How can I get it? That's why we say we consider that maybe we are looking for that cash flows, which maybe we are making an assumption, or we are making the reality that this will go in this way. We are going to cost it with this amount. Maybe, so when you are going to consider the assumption of getting that amount, maybe yearly up to 50 years, and consider the cost of that capital, then it's possibly you can be able now to analyze on how to get the discounting factor of that amount, that the discount rate of that value. That if I'll be able to get this amount and I'll spend maybe this amount, the possibility of getting a discounting rate to get the value of this amount will be this one. So maybe when we will go so far in the discussion, Mr. Nedi will try to show us on how so far we can be able to see, because this is not an assumption. This is the real thing, that when you have your money in now, you're going to invest it, and you're going to spend it maybe for 5 years. You can be able to know that in these 5 years, in these 10 years, what can be the discounting rate which can you use to make the value of my money. It's assumption of considering the value of our money in presence when you are going to use it for 5 or 10 years. That's what I can say about it.
All right. So let's get into the session on risk. So what does risk mean to you?
Risk may be something that you didn't expect, which if happened, it hinders you from achieving your objective. It may be something which is happening, or which, if not happen, hinder your objective to be achieved.
Yeah, that's pretty good. The only thing I would modify in terms of that definition of risk, you said something you didn't expect to happen. We can expect there's a possibility of something happening, right? So for instance, we can expect that it will rain, right? There's a possibility of it raining. It's a risk that it will rain. It's a risk that the rain will delay our construction. And the risk is actually higher during the rainy season. It's lower during the dry season, right? So it's probabilities of something happening. What else is risk? If risk happens, what is there? If you're outside, you're walking on the street, there's the possibility it might rain. There's a risk it might rain. It does rain, okay? So the risk occurs. And you've been walking on the street, what's the consequence if you're outside and it starts raining? What happens to you? Say it louder. You get wet. You get wet. That's a consequence. All right? That's maybe a consequence you didn't want. Sometimes in public-private partnerships, the risk happens. The bad consequence is you lose money. So if the consequence of the probability of rain occurs, the consequence occurs that you got wet, right? What could you have done to mitigate it? Mitigate is a fancy consulting word meaning lessen. What could you have done to lessen the consequence of getting wet? Have an umbrella, right? That's a mitigating strategy. All right, I think we're done with the session. We just identified a risk. We just discussed the possibility of the risk, we just went through the consequence of the risk, and we just discussed mitigation of risk. So I don't think we need to do the rest of this session. All right? Does that sound good? All right? We deal with it all the time. Risk isn't, it's not, as I have up here, it's not necessarily alarming. It's just a fact of life. It's a fact of these projects. We're not ignoring them. What we're doing, what we're going to do and learn through this session is we're looking to identify risk, and we're looking to figure out, okay, if the risk happens, what's the consequence? How can we lessen the possibility of the risk? So our risk assessment has some objectives, right? We need to understand risk for our financial analysis. It's going to go in and influence our analysis. It's going to, the risk of inflation could mean higher operating costs. The risk of there not being enough people that use our toll bridge means that our revenue can come down. So it's going to have consequences. We need it for our financial analysis. All right? Recognizing that there are risks, what can we do to lessen their impact, or not even lessen their impact? What can we do to lessen the possibility of the risk occurring? What can we do if it does occur to lessen its impact? And eventually, we talked about in the PPP definition, the key characteristic is transfer of risk. Well, who's going to assume the risk? There's two parties. There's the public sector, there's the private sector. Who's in the best position to handle that risk? So, in our objectives, we want to be realistic in terms of our risk valuation. We need to manage the risk. We've got to allocate the risk. Here are some steps in terms of managing risk in public-private partnerships. Okay? So I like to think of it in, really 5 components. Identifying the risk, and we'll go through how you do that. There are some risks more important than others. All right? If we build a bridge, if we have a bridge built and developed through a public-private partnership, a toll bridge, what do you think's a more important risk? That there are not enough vehicles using the bridge, or that the bridge gets hit by a meteor? Which one is more important? Which one's the lesser? The meteor hitting the bridge, or not enough vehicles using the bridge? Which one don't you worry about too much? If a meteor hits the bridge, that bridge, you can say bye-bye to the bridge, right? Goodbye, bridge. But is it going to keep you awake at night that a meteor might hit a bridge? So there's some risks going to be more important than others. Okay? If the risk happens, or the possibility of the risk, again, what can we do to lessen it? Who's going to bear it? What's the cost? So in terms of, this is just another way of looking at those 5 steps. So in terms of identifying risk, first of all, by the way, this is a good exercise regardless if the project's going to be done as a public-private partnership or through traditional public finance. You want to understand everything that can go wrong with the project. And there's different methodologies of using this, but you have what we sometimes refer to a risk workshop. Literally, you could be in a conference room, maybe smaller than this, but in a conference room with your transaction advisors, subject matter experts, certainly the representatives of the government, and you just start talking. The facilitator might organize it to look at different categories of risk, but you will come up really a lot of it just through conversation and talking, like, okay, what can go wrong? What can go wrong in trying to get the project developed, get it built? What could go wrong in the operation of the project? What could go wrong in financing the project? What could go wrong politically? You start thinking of all the things that could go wrong, and what you're doing is you're creating a list of potential risk. Sometimes it's going to be referred to as a risk register, just a list of the risk, okay? So now that we have a list of risk, say that 3 times real fast, we need to figure out what is the cost of those risks. How do we value that risk? So the very simple way to think of this is, let's see if we can work this out. We have a risk, okay? And let's go back to our bridge example. So what are some risks with a bridge? It's a toll bridge. What are some of if we need to have a bridge built through a public-private partnership, it's going to be a user fee model. That is, the vehicles are going to pay a toll. What are some of the risks associated with that project?
I mean the decline of the number of vehicles passing.
Right. So he said that maybe there's not enough vehicles that use the bridge. Well, we call that demand risk. Okay? And by the way, just to make our math easy, we're going to say that the bridge costs 50 million US. Okay? So we have demand. There are not enough vehicles that use the bridge. What are some of the other risks associated with the project? Oh, they refuse to pay? Well, if they refuse to pay, well, that's going to impact demand. That'll be an impact on demand, you know, if it's not affordable, right? What else could go wrong with the project? What?
Inflation risk.
Inflation risk, right? That could happen. That's going to increase our operating costs. Okay? Now, I'm going to give mine. I'm going to say there's a risk that, let's say, well, okay, I'll give mine, but then I need you to give me one more. Mine, my favorite one, of course, is the meteor. There's a meteor could fall out of the sky and hit the bridge. Let's say the bridge, so the bridge is going to be going over a river. Okay? What's another risk that you can think might happen to the bridge? And it could happen 30 years from now.
Political leader, they may decide to build another alternative law, which is not for...
Okay. Yeah. So what if politically, let's say 10 years from now, the political leaders 10 kilometers downriver decide to build another bridge, but it's going to be free? Okay? So I'm going to call that a competing bridge. Okay, and one more. I'm looking for something that might not be in anybody's control. What's another risk for the bridge? This is a river, bridge that's crossing the river. Oh, if we could start with her first. I think she may have had something. Like what she said, a fancy phrase, force majeure. All right, so the bridge, I said, costs $50 million US. We got the consequence. Okay, that is, what is the impact? What happens if this risk occurs? So if there's a flood and the bridge falls down, what is the value of that consequence? What is the value of that consequence? What's the value of the bridge falling down because of a flood? How much does that cost? Say it louder. 50, right? That's 50. You just lost your bridge. And we're not going to worry about inflation or anything right now. To get that built, again, is another $50 million. If the meteor hits the bridge, blows it up, how much is that consequence? Say it louder. You said it. 50, right? Yeah, you need a new bridge. Okay? If, let's say, and I'll help you with these other ones. So if there's a competing bridge, the government decides to build a bridge 10 years from now and doesn't charge to use it. It's 10 kilometers downriver. Well, in terms of if you're the private company that built the toll bridge, let's say the consequence of that is, let's say the consequence for that is, again, just to make the math easy, let's say that's a $5 million consequence, okay? Because they're going to lose cash flow, right? So we're going to say that's 5. If inflation goes up, what's going to happen to cash flows? Cash flows are going to do what? They're going to go down, right? So, and let's say that's a $4 million consequence. If demand, that is the number of vehicles using the bridge, isn't as strong as we forecasted, for regardless of the reasons, there could be a lot of reasons. Each of those, by the way, is an individual risk. If the demand goes down, let's say that's also a $5 million consequence. Okay? So now, one of the things I always say is risk is not some just abstract concept of something that might happen. We said that there's a risk that it might rain. Something really could happen. You could get soaking wet if you're out there and you don't have an umbrella. That's a real consequence. Well, these are real consequences. So my question to you now is, now that you have said what the consequences are these the value of the risk? Is this going to be the value of the risk? If a meteor hits the bridge, is the value of that risk, the cost of that risk, is it $50 million? But more importantly, they're not equal in terms of probability, in terms of the risk happening. So, next question I have for you, we got to look at what the likelihood is. Probability. And I'm going to ask you this. We're going to state this in percentages, okay? 100% is meaning it's absolutely going to happen. 0% means there's no chance it will happen, okay? And at some point, I'm going to need you to pull out a calculator. So, and there's you can give me pretty much any answer. So, what's the likelihood that the demand that we forecasted in our models, right? Let's say this is a 30-year concession. What's the likelihood that the demand may be less than what we forecasted? What's the percentage? Is it 100%? Is it 0%? Is it something in between? And if it's in between, just give me a number. What's the chance that our forecast might not be completely correct? Anybody?
Can be 20% or 30%.
Okay, let's go with 30%. Okay, we'll be conservative. So she said 30%. I think that's fair. It might even be a little higher than that. Okay? Demand forecasts are very difficult for toll roads. They're a little more accurate, by the way, for bridges because with a toll road, there's a chance that you might have a free toll road. You can find a free way to go. If a bridge, unless there's another bridge, you're swimming. You're either going to pay the toll or you're going to swim. Okay. What do you think the chance, the probability, the likelihood that we might have higher inflation at some point in our project? Okay, I'm going to say 40%. All right? We'll come back to the meteor in a second. This will be for all the astronomers in the room. What's the likelihood that the government will decide to build a competing bridge 10 kilometers downstream that will be free to users? What's the likelihood of that? Is it high? Is it low? It's going to be low, right? Because the government's going to have to come up with the money. It's going to be kind of tough to do, right? So is it fair to say that this might be, the risk for this is what? 5%? Okay, 5% sounds fair. I think we're being conservative. That's okay. What's the chance that there might be a flood? Now, I didn't say where the bridge is or whatever, but give me a percentage for the flood. You said 40%? Okay. Hopefully that's high. By the way, one of the things you hope they did during their feasibility is they factored in, technically, the situation so they could build a flood-resistant bridge. Notice I didn't say flood-proof. Very difficult to make everything proof. But so 40%, sure, why not? We'll put it in there just to see how it works out. Okay, now we got to get to the meteor. What's the likelihood that a meteor is going to hit the bridge? You said 1%? Oh my God. That's high. I hope that's high for all our sake. Okay? 1%. I'm going to say, how about this one? Maybe it's going to be 0.00001%. Okay? I really hope that's what it is. Okay? So now you kind of came up with the probabilities of something happening. What do we do with that? You have the probability, you have the consequence. What now do we do?
I just have a puzzle with that 40% of flood.
I'm sorry?
I have a puzzle with that 40% of flood.
Yeah.
I'm asking of having that much.
That's too much?
That big number.
Okay.
Yeah.
How about 10%? We'll use 10%.
What I'm concerned over that is that having a flood is not an issue, but what we think of there is about the issue of the bridge being eroded by flood.
Right.
And that can't be 40%, in fact.
Yeah, I agree.
Otherwise
It's probably
it has
too
been
high.
built by somebody.
Okay. So I just lowered it to 10%, and that might even be high.
Especially to a country like Tanzania where flood is not happening.
That's good.
My presupposition of 40%, maybe because I went out briefly, is only about functions of the bridge by the time the flood happens. It's not only about demolition of the whole bridge. It's that sometimes an investor may fail to do business for some times because the cars cannot pass because of being flooded. And I didn't mean that the bridge will be demolished. No, my concept was the failure to do business when the flood happened.
Okay, that's actually a good point, and that doesn't just apply to the flood. If you think about it, if a bridge is destroyed, whether by a flood or by a meteor, it's not simply the cost of rebuilding the bridge, it's the lost revenue for not being in operation over that time. So let's say instead of 50 million, it's actually 60 million. We'll put that same up here, okay? Because they're going to have lost business. This is not a complete list by any means. Anyways, now that we know what the consequence is, now that we know what the likelihood is, what we can actually now do is we can calculate what is the value of that risk. What is the actual value of that risk? And the way we do it, it's very straightforward. We simply multiply the consequence times the probability. This is where I'm going to need your calculators. So value of risk. So if our demand consequence is 5 million and the probability is 30%, what is the value of that risk? 30% times 5 million is 1.5. I heard somebody say it. That's 1.5. If inflation, if the consequence is 4 million, the likelihood is 40%, what is our value of that risk? 1.6. We'll get to the meteor in a second. I'm going to need somebody with a calculator. If the government's going to build a competing bridge, and we're saying if they build a competing bridge, the consequence is 5 million, 5%, what is the value of that risk? It's going to be $250,000. If there's a flood that knocks down the bridge, puts the bridge out of commission, the consequence is 6 million. Okay? Anybody have a calculator? I want somebody to, I need somebody to multiply 60 times 60 times 0.0000001 and tell me what that is. It's 0.06? Okay, all right. So you're saying it's only 6 cents. Okay, I'll go with that. So what we've learned is when we look at these risks, even though, for instance, the meteor, the consequence is huge. If a meteor hits the bridge, it's going to blow to smithereens. It's going to be out of commission for a while. There'll probably also, by the way, be widespread devastation. The economy, the tank, people will be eating cats and dogs. It'll be awful. The civilization as we know it might be coming to an end. Not going to be good. Yeah. The value of that risk, the consequence is 60 million. The value of that risk is only 6 cents. 6 cents. It's meaningless. Okay? On the other hand, if the government builds a competing bridge that's free, the value of that risk is $6 million. Big difference. Okay? So this is getting all the way back here and finding what I did with the clicker. Here it is. What we've just done is we've assessed the risk associated with that bridge project. Yes, there's a lot more involved, there's a lot more risk, but in essence, that's what we're doing. We just created a risk register that's looking at potential risk, what the consequences of those risks are, what the likelihood of the risk is, what the value of the risk is. By the way, do you take this as gospel? Is this absolutely 100% correct? And let's say, this was done. We had all sorts of experts. We hired subject matter experts. We had transaction advisors working with us. Is it absolutely 100% correct? No. Hopefully it's an educated and informed analysis. What's our risk mitigation strategy if we think it's going to rain? What are we going to do? If you need to walk outside and you think it's going to rain, what do? You bring an umbrella. That's your risk mitigation strategy. I don't know if you have this saying here in Tanzania, but back in the United States, we say if you want to guarantee that it won't rain, carry an umbrella. I've gone to more events where I brought an umbrella and it doesn't rain, but I got to carry this umbrella around with me. All right? And seems, what's that? Jolly good. It seems, and by the way, it also seems like I get soaking wet and it pours on me when I forget to bring an umbrella. All right? So one of the things we can do, we can avoid the risk. Okay? If you want to avoid the risk, let's say, one of the risks we didn't talk about on a bridge, if there's an accident on the bridge, okay? If there's an accident on the bridge, what happens? Fewer vehicles can cross the bridge. Forget it, there's also the accident, but because there's now maybe traffic's going to be blocked or delayed, means fewer vehicles can go across the bridge. What's the impact? It means our revenue goes down during that time. We have less revenue. Well, one of the ways you do that is in addressing that risk, is you make sure you have a safely functioning bridge, that we don't have potholes in the bridge, the road surface is always in good shape, our safety devices are in place, we manage the traffic smartly, and that helps us avoid the possibility of an accident. But we can't simply control human behavior. If it does occur, we want to mitigate it. We want to lessen the impact of it. How do we do that? In the same example, we make sure that we have an emergency response team. They're out there quickly. They clear the accident quickly. They get the traffic flowing again. The other thing we can do is we can transfer the risk. So governments themselves build toll bridges. If there's an accident on a toll bridge that the government owns, that means the government revenue is going to go down. That's a risk to the government. If that toll bridge is built through a public-private partnership, what you've done as a government, you've now transferred that risk over to the private sector. And they're going to have to handle it. All right? So we can avoid risk, we can mitigate risk, we can transfer or share risk. Now that we've identified risk, we've looked at the strategies to mitigate risk, now we allocate risk. There are going to be some risk that are going to be retained by the government, and there's going to be others that we're going to be able to shift over to the private sector. And by the way, there's also going to be risks that we're going to share, that we'll both handle. We'll talk about allocation a little further along. Lastly, now that we've done all this work, it's all our risk strategies, our allocation of risk. What document are they embedded in? Where do you find risk allocation? What holds it together between the public and the private parties? What's that? He said PPP agreement, the contract. Okay? So in that, now you got to, as the government, which you are, you need to monitor that agreement. You need to evaluate their performance. And this is not a week where we're spending on monitoring and evaluation. But remember, that's a key phase in the PPP project cycle. But one of the things is, by the way, it also goes to risk mitigation. As the government, in your monitoring and evaluation function, one of the things you do that for is not simply to penalize the private partner. That's really not the purpose of monitoring and evaluation. Maybe a consequence of monitoring and evaluating the contract. But what you're really trying to do, this is the partnership part of the PPP, is you want to see if there's a problem developing, that a risk is starting to manifest itself, that it might happen. And then with your private partner, what you want to be able to do is you want to be able to address that before the risk actually occurs. Okay? Very critical. So that's risk monitoring and control. Having examined public-private partnership risk identification and appraisal techniques, my colleague Ned White We'll now take you through financial statements and accounting for public-private partnerships. Ned will also show you some case examples.
So what I want to do here today is show us at least some background on financial statements. Pardon me here. And we will see here that when financial models are presented to us, there's a couple of different formats from the, you could say, the accounting profession, largely, of how the financial condition performance of any firm or enterprise is depicted. So we're going to talk about, understand the difference between what we mean by financial analysis, which is cash flow. That's usually the easiest to understand because we just measure everything that is in cash. We don't measure anything that is non-cash. And then to compare that with income analysis coming from the accounting profession, which has a slightly different, has some slightly different approaches to how it values certain costs and benefits here. So the difference between those two, so that we understand like the difference between a profit and loss statement and a cash flow statement and others, but this is from practical perspective how financial models are presented. I also want to show you some important ratios or outputs that show the bankability of a project, like the debt service coverage ratio and a couple of others. And I'm going to do some, we'll do a little bit more with rates of return. One of the things that we will see is that there's more than just one rate of return. Yesterday I showed you there's a rate of return on the equity investment in a project. So 3 of the major financial statements that you will see that PPP financial models are include are, number one, there's in the United States we tend to call it an income statement. You may know it more commonly as a profit and loss statement. It's the same thing, just different regions having different common terms for that. We'll talk about that. These are, and as well as the statement of cash flows. You saw a couple of times yesterday I showed you the waterfall model of cash flows, how cash flows through a project. First you start out with the revenue, first you pay, next you pay the operating costs, then you pay the debt service, then you pay your taxes on income, and then you pay your profits. So these first 2 projects have, these first 2 statements though, are different depictions of a flow concept. Slight differences in them, which we'll talk about. The third one is a balance sheet. Some of you would probably know this. What is a balance sheet? Yes, thank you. It is a stock concept at one given point in time. Oftentimes you might see it as given as the last day of the year for an annual balance sheet. Could also be done on a monthly basis, but it shows it's like a snapshot. At one point in time, what are the assets and what are the claims on those assets or the liabilities and the shareholders' equity. Understanding how balance sheet works requires a lot of knowledge about accounting, and we're probably not going to go into too much about it. The other 2 statements tend to be more important in PPPs and in project financing, because in project financing we say that the investors and the lenders, they are looking for the future cash flows from the project itself as the source of repayment. That's what we mean by a project financing. The project will pay for itself. We structure a project that is strong enough and that lenders are looking to the future revenues as the source of repayment. That differs a bit from what we'll call corporate finance, which is where lenders typically will say, well, we will lend to an investor based on their collateral, their balance sheet of current assets. We want to know that if they're unable to repay, say, the loan that we give them for whatever purpose they choose to use it for, at least their assets provide the collateral for us to be repaid. In PPPs, lenders don't typically lend based on what they can do with those assets. It's really based on the future cash flow of the project. So don't be surprised here if we're not going to be spending too much time on balance sheets. We'll talk a little bit about it, but actually being able to program or manipulate and understand balance sheet requires a little bit more accounting knowledge here. One of the things that I'll just point out here, we'll talk a little bit about this, is the specific perspective that lenders have on these projects. And one of the things that we've said that infrastructure projects have in common is they tend to be capital intensive and they tend to be long-termed, right? Means you need a lot of money up front to start out. Before that bridge or that road can handle its first car, you have to put in a lot of money up front, and when you build it, you don't build it that it lasts 3 to 5 years. We build these things expecting them to last, say, 20 or 30 years and longer. So lenders will oftentimes look at, if they're expecting to be repaid from the future cash flows, tell me the ratio of how much cash is available to pay debt service. That would be right here. Show me your revenues and show me your operating and maintenance costs. After you have paid your operating and maintenance costs, how much cash flow is available here to pay each shilling or dollar or unit of debt service here? And we'll come back to this in a couple of minutes, but I'll ask you a question here that oftentimes lenders are looking for a minimum in that ratio of at least 1.3 to maybe 1.5. It varies from sector to sector and project to project. But they don't want to see a ratio of just 1.1 to 1. Show me that for every $1 of debt service you owe me, that you've got $1 here. I want to see a margin or a cushion. Show me you've got 1.3 or 1.5 as usually a minimum. We'll come back to that, but think about this is how lenders are looking at a project because they're expecting to get paid back from the future cash flows of the project, not necessarily from the assets in that project company. Now, so the waterfall model of cash flows, another way when I'd sort of first learned this as a young financial analyst was think of it as a funnel, sort of like that this is a statement of cash flows in any enterprise. We start out with a lot of money at the top. That's the revenue that we take in. Or as John had mentioned, that's sort of our top line here. We're taking in revenue from either our end user fees from consumers or it's from our availability payments, but that's our revenue. And then we say, well, we pay our expenses from that cash flow in order of priority. So in this example, who gets paid first? Who gets paid first in this example? Well, even before that, we're saying that we pay our VAT tax first, right? Okay, so we pay our VAT tax, and as we pay these, the residual cash flow shrinks, right? So like a funnel. Although it's not exactly like a funnel, but it means that we start out with a large amount of money up here. We pay our VAT tax, we pay our operating and maintenance expenses, so that's labor, that's all of our suppliers if they're supplying us with fuel or water or whatever our key inputs are. Next, we pay our debt service. What does debt service mean? Can anybody tell me?
We pay the principal plus interest.
Principal plus interest. So coming back to our cash flow, statement of cash flows here, we pay interest, we pay principal, then we pay our taxes, our corporate taxes that are owed. And to do that, I will say that we need the help of accountants to actually calculate, according to the tax laws and the tax rate, how much we owe in corporate taxes. We need that because it's not simply like VAT tax is a simple percent of your gross revenues, right? Pretty easy to calculate. Your corporate taxes or taxes on profit or income, you're given certain allowances. You'll need accountants who will basically say, well, we can calculate certain deductions. You're not going to pay a flat rate, but you actually need their help according to each country's local tax code. And what you end up with here at the bottom is your net cash flow from operations. So this would be the classic waterfall model of cash flows. It's pretty simple to understand because we're only measuring cash. Now, let me give you a scenario here. Let's say you're a lender, you're a banker, and I approach you for a loan. And I say, well, I want to borrow some money. Maybe it's to expand my house, or maybe it's to buy a nicer car or something like that. And one of the things that you're going to want to know is, well, Ned, how much money do you make? If you're going to lend money to me, you're going to want to know what are my sources of income so that I can repay you this loan. And what if I tell you that, well, last month I've had, I don't know, lots of money coming in. In January, I got paid lots of money from my clients. My cash flow was coming in, that was good. But let's say I didn't do any billable work in January. Meaning that I had clients that I had done work for back last year who were paying me in January. Now, if you're going to make a decision to lend to me, which is more important? What do you want to know? Is it my cash flow? Do you want to know how much cash I actually receive? Or are you going to want to know, well, Ned, what are your monthly billings or your invoices? How much work are you doing each month? Which is more important to you?
What is very important in this case is to know how much you earn each month.
So you're going to want to know in terms of cash flow, because as a consultant, I sometimes have cases where I'll do work for a client, I give them my invoice. Sometimes I have good clients who will pay in a couple weeks. Sometimes I have clients who won't pay for months. I have even had the unique experience of having clients that didn't pay me for 5 years, finally paid me. But think about that. So which is more important to you? Is it the billings that I'll say that here last month, here's what my invoices are, or is it my cash flow? Which is more important? So here's the question, which is that if you're going to lend to me and sort of say, well, is Ned a good credit risk? Does Ned make enough money that if I lend him money, he can actually pay me back? Are you going to want to know cash flow, or are you going to want to know income, or do you need to know both?
Cash flows.
Okay, some would say cash is king. We also want to know, what is your ability to actually collect from your customers? You may do all kinds of work, but we find in some cases, especially those who deliver public services, that maybe you deliver water or electricity to many customers, but you have a very tough time collecting from them because some just don't pay, and you're not allowed to shut them off or deny them service. So think about this here. Now, is there a link between the two? Meaning my income and my cash flow. If I told you I didn't do any billable work in January, January was, I don't know, an easy month for me. If I didn't do any billable work in January, what is that going to mean for either February or March? What's going to happen to my cash flow if I didn't do any billable work in January? It's probably going to go down. So there is a link between the two. The question, though, is, which is more important? Do you only need to know one of those, or do you actually need to know both if you want to get an accurate picture of Ned White's financial condition? You need to know both. Right. So keep this in mind here, that when we look at PPP projects, because some will say, well, really cash flow is pretty easy to understand. I know it's cash coming in. This is also when we compute an IRR for the equity investor. That's done on cash flow. But cash flow doesn't give you the whole picture. You need to also combine that with what we'll call income analysis, and we'll show you how that differs a bit from cash flow. So we start out with cash flow because it's the easiest to understand. We're only counting things that we either collect in cash or that we spend in cash. So when we talk about even the top line here, revenue collections, this is in cash. If, for example, and this can be a significant risk in PPP projects, you're a PPP provider, you are distributing water, and it might be that you're distributing water to schools, to hospitals, to correctional facilities, or whatever, and you're having a tough time collecting from them. Maybe they don't pay their water bills. And maybe it's going to be very difficult for you to actually enforce collection from them. So there could be a big difference between you're saying, well, from an income standpoint, I'm selling lots of water. My income should be very high. My actual cash collections is quite low because I can't collect. Reflects a key problem and a risk that needs to be dealt with. So this is cash flow from operations. Now, income, as we've seen, differs from cash flow because it follows a couple of key principles. One is it's a measure that comes from the accounting profession with its own specific definition. So for example, one of the ways that you're probably familiar with it is, I said I'm a consultant. It means I do work for clients. Sort of at the end of the month, I will send them my bill for services. I will recognize that as that is income that I have booked. I haven't gotten paid for that yet, but I'm recognizing that as income. The accounting profession, and let me just see by show of hands, how many of you have training in accounting? How many of you taken classes or have training in accounting? Okay, good. I welcome your participation in this. The accounting profession has its own key principles, like things like it values consistency and measurability over things like current market values. So some of you who might be familiar to this might say, yeah, but why does the accounting profession do things that maybe don't quite accurately reflect current conditions? Okay, the other thing here is that one of the primary goals of income statements, not the only one, but one of them, is to also to calculate how much taxes are owed by a corporation. And in each country, government tax codes are written to give key incentives, especially to businesses, to do certain things. Like it says, if you spend more money on your operating and maintenance costs, like hiring staff, you will pay lower taxes. That is a deduction from your taxable income. So if you go out and you hire more workers, you're going to be spending more money, you're going to get more tax deductions, you're going to pay less in taxes. That's one thing. There's another thing that it does. It also says typically that if you borrow money to expand your firm, you borrow money for new capital investment, the interest expenses that you pay, you have to, as part of your debt service, that's tax deductible. That's going to lower your taxes. So it gives incentives to businesses to do things like expand, hire more workers, borrow more money, undertake new investments, and it means your taxes are going to be lower. So keep in mind here that when you look at income statement or a profit and loss statement, you might see differences. You might say, yeah, but that's not actually how cash really works. You're even recognizing, we'll see here, non-cash expenses. Let's say it's got an expected life typically of 5 years. We may say, for sake of argument, that each year you use up 1/5 of the value of that truck. Then each year you could deduct 1/5 of that, or 20 million shillings. Say, I can take that away from my taxable income. Now I'm paying even less taxes. At the end of 5 years, it means that the truck has, at the end of its expected economic life, on the balance sheet, we would say that the truck has 0 value, book value. What is it time to do after 5 years of owning and maintaining that truck? If you're going to be a going concern, what do you need to do after 5 years? So one thing a balance sheet can tell you is sort of how old are the assets. And sometimes you'll see then it will show you before you might buy or invest. Here is a company whose assets are very, very old. If they're going to continue to be a going concern, they better come up with a plan for renewing those capital assets. Otherwise, they may not be a going concern anymore. Okay, so government tax codes, they give incentives to do these things. So if you're new to accounting, don't be too troubled on, yeah, but why is it that things like net income is so low? You take all these deductions, you pay taxes, you've got net income that's really low. That doesn't sound very good. And you're saying that's the way the accounting profession looks at things. We've got to look at cash flow as well, and that will oftentimes paint a different picture. So therefore, keep in mind, many private firms will hire accounting firms and reward them generously to say, what we want you to do is don't cheat, but follow every rule and take advantage of every single deduction that we possibly can, because what we want to do, obviously, is pay as little taxes as we need to. That's just private business. That's the way it works. I'm not saying hide income. I'm not saying escape from paying taxes, but this is an incentive. So oftentimes when you see this, good accountants who earn their money are the ones who will say, well, according to the rules as written by government, you can take deductions for this and this and this. Your taxable income is extremely low, to which corporations will say, that's good. That doesn't really reflect our cash flow. In fact, the less taxes we pay, the higher our cash flow would be. Taxes are a cash flow item. So don't be surprised that you will find cases here where the net income as calculated by accountants is low, but the actual cash flow is different, maybe even much higher. That's not unusual. Now let's talk a bit more here about depreciation. Now I'd mentioned before that one of the things that defines infrastructure as a sector is that it's capital intensive, right? Unlike if you were to go out and start your own consulting firm, which you could easily do, you don't need to come up with a lot of capital investment to start a consulting firm. In infrastructure, we borrow a lot of money, we build very big structures, they last a long period of time, but because we have lots of capital assets, when we build buildings or roads or plant or equipment or trucks or all of these capital assets that are needed for an infrastructure project, the more depreciation a firm is able to recognize on its income statement, because it's a deduction from your taxable income, the lower your taxable income will be, the lower taxes you pay. The incentive of the tax code is telling businesses, go out and make the investments. If you go out and you borrow money, if that truck is 6 years old, and now it has an economic value of, a book value of 0, fully depreciated. If you were to go out and borrow the money to buy a new truck, then you would be able to deduct $20 million in depreciation on that. So go ahead, borrow the money, buy the new truck. Now you're actually going to be paying lower taxes than if you just hold on to that old truck and you don't get any benefits of depreciation. It's already depreciated. So for highly capital intensive infrastructure projects, depreciation is a large and important expense. So don't be surprised when we see this. Many PPP infrastructure projects can show even negative net income levels and positive cash flows. So let's look now at how a profit and loss statement or income statement is constructed. It has the same funnel shaped. It is a flow concept. So here on cash flow, do we recognize depreciation? No. We recognize principal repayment. That's a cash expense. The profit and loss statement, do we recognize depreciation? Do we recognize principal repayment? Okay. Then we have our taxable income. We do this to compute our taxable income. We multiply this by the tax rate. What we end up with here, it's not called net cash flow, it's called net income. All right, another thing that I want you to know, it's not crucial, but there's also in any enterprise, there's 3 different sources of cash. You can get a corporation, a firm could get cash from its operations. This is most typically what we're familiar with. You could say that's from its core business. That's basically from selling its products and collecting cash from customers. There's also a cash flow statement from financing activities. For example, a corporation might say, I don't know, you might find that automobile companies do this, that they'll say, we not only make and sell cars, but we will also give customers loans so that they can buy our cars and repay them over, I don't know, periods of years. We get interest when we do that, right? So what this does is basically says, well, let's make it clear how much money the corporation actually gets by manufacturing and selling cars. That's cash flow from operations, and how much it might get from cash flows from financing activities, because there's sort of 2 different functions here. And when we assess You could say the financial condition of any company. We sort of want to know, well, are you making all this money that you're making? How much of it is actually coming from your core operations, and how much of it might come from the fact that you're lending money to customers and maybe interest rates have gone up and now you're making more money from customers, for example, but that doesn't really come from increased sales, that comes from financing activities. Or you can also have incomes from investments, which it could be that a company makes investments in other companies and receives profits on those investments. So different ways of doing this. To keep it simple for us, I don't want this to be a class just on accounting, almost all PPPs are single-purpose project companies. We create a project company and we call it a single-purpose project company because, well, it makes the financing easier so that when investors invest in the project company, when lenders lend to it, they want to know that the money is going to be used to deliver this one service and get paid for it. They don't want to necessarily say, well, it's going to go into the project company, but the project company is going to sell many different lines of business. It will sell many different products. It'll have many different lines of business. Now, this is why oftentimes when we talk about the SPV, the single-purpose vehicle, sometimes a better name for it, one that I like, let's call it a single-purpose project company, because that's really what everybody expects and why it is that we come up with that pretty expensive structure. We incorporate a new body, we have contracts, we've got a whole network of a security package of agreements because it's a single purpose. So really it means that for PPPs, we can largely assume that almost all the cash flow is going to be from their core line of business, delivering that single purpose. So to compare and contrast the two, if you will, what is the difference between cash flow and income? Cash flow is, we'll say that financial analysts look at this. Sometimes you might say financial analysis and accounting, they're kind of the same thing. Not really. A financial analyst really looks at cash, and typically they typically look forward, which is to say, should we take this new investment or not? That's our decision point. We're looking forward and saying, well, how much will it cost to invest in it? How much revenue will we get? What will our net present value be? We're looking forward. Not always, but usually we say that the accounting profession is a bit backwards looking. It's basically saying, during the last year, let's prepare the financial statements or the profit and loss statement to compute taxes for last year. Here's how we performed last year or the previous year. A financial analyst is basically we call this capital budgeting, which is basically should a corporation or should an investor undertake a new investment or not? What are all the risks? What are the expected returns? And again, financial analysts will basically say cash is king. I'm going to be looking at net cash flow when I compute my IRR, for example. We focus on things more like accuracy and risk valuation. We look at actual cash collections. We look at actual cash paid for O&M costs. We look at debt service, including principal and interest. And what we end up with is net cash flow. Now, I want to come back to something that we'd covered before. There's something that lenders look very closely at, which is the debt service coverage ratio. We've seen this diagram before, the waterfall model of cash flows. We said the debt service coverage ratio is because lenders, they're counting on the future revenue for their source of repayment. So lenders are oftentimes looking for a margin here. Could be 1.3 to 1.5. Sometimes it's even higher. Who can tell me, why do lenders look for this additional cushion or margin in a debt service coverage ratio?
Yes, it's to make sure that there is sufficient cash to cover for the debt service. Yeah.
Sure. You want to know that these are the pro formas or the projections saying we project this is how much revenue there will be. We project the operating costs. This we're pretty certain of. We know what the debt service will be. That's in our loan agreements. What we want to know is, can the project still handle a reasonable amount of uncertainty or risk? Maybe it's a reduction in revenue. Maybe we were counting on revenue of one level and actual revenues are 10 or 20% smaller. Or maybe our O&M costs have increased. Or maybe there are other risks affecting the project that could affect the ability of the project to service its debt. And this is why lenders are looking for that margin. Again, I've showed you this before. You're going to be programming this afternoon. You're actually going to be using some tools in Microsoft Excel to compute not only what is for a loan amount, I'll give you the loan balance, how much you're borrowing, what the term is, and what the interest rate is. And I'm going to ask you, you compute the total debt service. How much are we going to have to pay in regular payments over the term of the loan? So one of the lower risks projects tends to be something like an independent power project with a single off-taker. That means the only risk that the private partner takes is they design it, they finance it, they build it, and they operate it, meaning they generate power when called upon to do so. But they don't face any market and demand risk. We say that they get paid a capacity payment for making the capacity available, meaning they're always available whenever, according to their contract, required. So really, it's lower risk. They don't take the uncertainties of they only get paid if they're generating power. That risk is taken care of. So it's a lower debt service coverage ratio. We see that in the IT sector, you don't see a lot of project financings in this sector, but in the IT sector, there's a higher minimum debt service coverage. What do you know about the IT sector? How does it sort of differ from something maybe like traditional fossil fuel power generation?
Yeah, the technology gets obsolete earlier.
Technology risk. So the more risky a project is, you'll see that there's a higher expected minimum debt service coverage ratio. So one of the things that we'll need to know and build into any model on financial feasibility is to look at if we expect that it's going to require debt financing. Larger projects do. What do we expect borrower or lenders would require as a minimum debt service coverage ratio? And you see that there are other sectors here as well. So here we have a project with a term of just 10 years. A total capital of investment of $100 million. We're going to finance this using 75% debt and 25% equity. Remember, we said that this is leveraged. What does financial leverage mean? Who can tell me? I've used this term a couple times now so far. What does financial leverage mean?
It means that is how the company depend on debts and the equity.
Okay.
The ratios in which it depends.
When we say that a project is financially leveraged, what does that mean about the ratio of debt and equity? What does that mean? What does financial leverage mean in terms of that ratio? Is there more equity or more debt? There is more debt. We say that we're using a smaller amount of equity, leveraging it to raise up a much larger amount of debt. That's what you typically see in a lot of infrastructure projects. Equity is more risky, requires a higher rate of return. It also tends to be more scarce or difficult to source. You don't just have lots of people with plenty of equity and can fund things 100% equity. You find that you will actually get lower tariffs, lower prices, if you have the ability to borrow money from lenders, paying them lower interest rates. And then we've got here a term on the debt and an interest rate on the debt. We've got an estimation here of what the revenues would be. They're fixed for 10 years. We've got operating and maintenance costs. We're going to make simplified assumptions here. They're fixed for 10 years. Depreciation, we've covered that one. We're going to use 10-year straight line depreciation. So that's going to mean that of our $100 million initial investment, we'll make a simplified assumption here that every year we will recognize 1/10 of that or $10 million as a depreciation expense, and then we've also got a corporate tax rate. Let's see what this model looks like. Now, with this basic information, we can at least come up with an initial analysis of a model. It's fairly simple, but you can see it. One of the reasons I'm giving this to you is you can see it all on one page. Hopefully the font is big enough that you don't have to squint. But you'll see up here we have the capital investment at the top. Total investment is 100. 75% is debt, 25% is equity. We've got a term on the debt of 10 years. We've got an interest rate on the debt of 12%. We have a depreciation expense, which is 10 million each year, straight line. I've highlighted that. And here I've got the income statement, and here I've got the cash flow statement. The income statement, or profit and loss if you prefer. Basically, you'll see here the revenues are the same for all 10 years of the project. They're at 50. We can make more complicated adjustments later on and show changes in income or changes in revenue, changes in expense. But I'm trying to keep it simple for this first look so we can see it all on one page. We've got our O&M costs here at 29. Because this is our income statement, profit and loss, we're recognizing depreciation, right? All right, and then the revenues minus operating expenses minus depreciation, that's 11. Now we have interest expense. Interest expense is the interest on a loan of $75 million for a term of 10 years at 12% interest. So if you're to look on the formula here, you'll see that there is a formula for Microsoft Excel called IPMT. What would you guess IPMT stands for? Interest payment. That's your interest payment formula. Now, here's a question. The revenues stay the same. The operating and maintenance costs stay the same. Depreciation stays the same. Earnings before interest and taxes, that's EBIT, that stays the same. But wait a second, why, when I'm looking at interest, it changes? 9.6, 9.05, 8.44, why is it changing?
It is due to the period of time.
As you would expect during the life of a loan, you're absolutely right. The amount of interest you pay, if it's levelized payments, most of that is interest. You pay, as you pay down the principal, your interest payments get less. So you will find that even when everything else is held the same, your interest payments are going to change over time. And the formula, when you come up with the formula, it's not a simple formula like maybe the IRR, as we'll see, but you actually have to say, this is the interest payment for this year. One of the inputs in this formula is the year. Similarly here, the 6.99, that's the interest payment specifically for year 5 in a 10-year loan like this. Okay, we've got taxable income here. We've got taxes paid here, net income. And we also see that net income changes, starts out quite low, right? Less than 1 million on a $100 million investment for year 1. Now, there's different ways of showing a cash flow statement. I'm taking some shortcuts here, so bear with me. I didn't want to do the full direct model, but there's another way to come up with net cash flow, which is a shortcut of saying, well, let's start out at the bottom here. This is the funnel, right? This is the funnel of our profit and loss statement. We start out with total revenues, we end up with net income. Another way that we could get to our net cash flow is just a shortcut of, we start out at the bottom here, we add back depreciation because that's a non-cash expense, we subtract principal repayments because that is a cash expense. What we get is our net cash flow. That's a shortcut. Now here, this is sort of strange. Down here in bold I have the net cash flow. How much is the initial equity investment in this project? 25, yep. We show that here. That's what they put in year 0. That's money going away from us, right? Here are the net cash flows. Keep in mind, is the IRR on equity, is that computed based on net income from the profit and loss statement or net cash flow? Which is it? Net cash flow, you're right. So, now lastly here, I'll show you down here at the bottom. Okay, we've got an IRR on equity of 18.2%. And once again, what is the IRR? I've heard this term before, but you tell me. The IRR is what is it?
IRR is a discount rate that gives us zero net present value.
Very good, excellent. So at a discount rate of 18.2%, if we discounted each of these expected future cash flows at 18.2%, brought them back to the present, they would equal positive $25 million. Make sense? We put in 25 million, we would expect the discounted, the sum of the discounted cash flows we would expect back is 25 million. So that gives us that. Lastly here, I'll show you the debt service coverage ratio, which is if we take 50, it's our revenue, minus 29, our operating costs, that is the total cash available to service debt, right? Also called EBITDA. For the fancy, we've got some accounting friends here. What does EBITDA stand for?
That means earning before interest, tax, depreciation, and amortization. Yeah.
It is the total cash flow available to service debt. We've got 21 million there. Our debt service, this line comes here, 14.1 million. That is total principal and interest. There's even a PMT formula in Excel. PMT is basically just compute total debt service. And it's really nice because it's the same for every year of the life of the loan, right? It's the same, 14.1. 14.16 million, that is total debt service on a 10-year loan of 75 million at 12%. And the ratio of 21 over 14.16 is 1.48, which we might say, well, it's generally in the range. Lenders would probably look more specifically at all the individual risks, but here we at least now see all on one page a financial model. And what you're typically going to see in practice when you're working on your real PPP projects is simply a more detailed version of this. Instead of it all being on one page, though, it'll probably be on 10 or 12 pages. And so you'll have one worksheet that maybe is just dealing with capital investment. And instead of a nice round number of 100 million, it's going to itemize it, and it's going to talk about site preparation and civil works and construction and equipment supply and all these kinds of things. So you'll have just more detail under there. You might even have a totally separate worksheet, depending on the detail, of total depreciation amounts for each asset class. Might sum up to a number that we get there, but there's just more detail behind it. Similarly, you'll have a profit and loss statement. You'll also have a cash flow statement. You might, for some projects that have many different classes of users, you might have concessions with different classes of users that are industrial, commercial, household, lifeline tariffs. So you might have a worksheet that just has all the details of different tariffs for different classes of users, but it all sums up to a number here. And you'll have a couple more. But what I wanted to show you here is at least now we've put all the pieces together and we can see it on one page. Well, our traditional IRR formula, when we put into Microsoft Excel, we say compute the IRR and it gives you a rate. That rate is like an interest rate. Saying if we were to treat these cash flows of here's your deposit and then here's your net cash flows, we are assuming that each net cash flow gets invested back in the project, just like the offspring of livestock. You're not going to say, okay, well, we're going to take all of the young offspring and sell them. We're going to keep them in the herd. They are going to then become breeding. We're going to earn interest on interest. That's compounding. So the traditional IRR formula sort of looks like this. We'll put our deposit in up here. When we get a net cash flow, Just like an interest payment. We don't withdraw that from the account and go spend it and only be left with our principal deposit. No, that goes back into the account, right? Then we earn interest on interest. Correct? Now, in most PPP projects, where we'll say, here's an independent power project, the contract is to provide 100 megawatts of capacity. You build the capacity, you make it available, we'll make a payment to you, and you get a net cash flow. Does the investor then say, okay, that first year's cash flow, I'm going to reinvest it in the plant so that in year one it's a 100 megawatt plant, in year two it's a 110 megawatt plant, in year three it's a 121 megawatt plant? Is that a realistic assumption? No, PPP contracts are fixed. It sort of says you provide the capacity, we'll pay it you. You can't put your, there's rarely is there the option to reinvest your earnings in a bigger and bigger plant. It's not a realistic assumption. What is it that you can do if you're the investor and you do have a net cash flow? You can't really put it into a bigger plant because your contract already defines, nope, it's for 100 megawatts. What can you do with it? You can't put it back into the project and make a bigger project. What can you do with it?
Really diversify.
You can take it out and put it in a bank account, essentially. Is a bank account going to have sort of is the interest that you would earn on a bank deposit going to be the same as the internal rate of return on your high-risk investment? No, bank deposits, they're very low risk, very liquid, right? In PPPs, for all of the risk they're taking, investors. So you have a problem here that the traditional IRR model doesn't really fit a lot of PPP projects. When we come back here to this one here, and I compute an IRR of 18%, this 18% assumes, well, when we get 6.37 in net cash flow in year one, that goes back into the project and that continues to earn 18.2%. Same with each of these others. They go back into the project and they continue to earn the internal rate of return. So is the IRR realistic? Does it really tell us? Anybody want to answer that question? Does the IRR, the traditional internal rate of return, does it accurately represent the return that an investor is really making? Oh, there is something here called the modified internal rate of return. And it deals with it by saying, let's say that the project itself produces net cash flows at one rate, the traditional IRR, but when we do get a payment from it, all we can do is we can invest it in a bank account, a low interest account. We'll call it a finance rate, something that is much lower. So one of the outputs that you're going to see is something called MIRR, modified internal rate of return. It's basically saying here that we can do two things with our cash, the net cash flows. We can either distribute it, take it out of the project as dividends and pay it and get no return on it, or we can deposit it into a bank account, which is going to be lower risk and low return, and we're going to earn a lower rate of return on each of those net cash flows. That's what the modified internal rate of return does. So the MIRR calculates a new rate. One of the things I want you to remember is the MIRR will always be lower than the traditional IRR. The traditional IRR sort of overstates the rate of return that we can earn on a project. The modified IRR says, well, we'll generate net cash at one rate, but once we've generated that cash, we can only earn a lower rate of return on that. So here, I think the traditional IRR was, in this example, was 17.5, but that was overstated. So when we have a investment and refinance rate of 12% as given, then the MIRR drops to 14.6. Again, what you want to do is you want to show all of these measures. You want to show the traditional IRR, the project IRR, you want to show the modified IRR, you want to show the debt service coverage ratio, you want to get the whole picture of the project. So, Now we are beginning our second computer exercise. First thing that we want you to do, now that you're a little bit familiar with this, is to calculate loan payments. So when you have a loan payment, like in this example, we say, what if we were to borrow $50 million at a 9% rate for 8 years? The PMT formula, just equals PMT, will calculate for you the debt service payment. That's principal and interest. And this will be the same for all 8 years of the loan. And you'll see here that the major inputs are, we have first, what is our interest rate? What is the term of the loan? What is the present value, your principal value of the loan here? And then lastly, you put a 0 in if you expect that the loan is all paid off. If you say, what is the balance at the end of the term? Balance is 0. It gives you the flexibility if you wanted. Maybe you wanted to say, what if I want to assume that after 8 years I've paid off half of the loan? So I'm going to have a terminal value not of 0 but of 25 million. It could calculate then the debt service payments under that scenario. So there's flexibility. So here's your assignment. Open up a blank worksheet. A PPP project plans to borrow $20 million to construct a new solid waste disposal facility. The term of the loan will be for 10 years. The interest rate is 8%. What is the annual debt service payment that the investor should expect to make each year? There is the formula, and there is the problem. Go ahead and tell me what you get. You just compute the formula once and you basically copy it across and wow, simple. Now we're going to add a little bit of complexity here, which is to calculate the interest payment. Is the interest payment the same for every year of the life of a loan? The current year, you have to specify what the current year is, the interest rate and the number of periods. So for example, here I've got a loan, and do take note, I took the time to label this. It takes only 2 minutes to type in loan amount, that's present value, that equals 10 million. Interest rate, that's R, that equals 11%. Takes a little bit of time. Here I am calculating the interest payment for the second year of a loan of $10 million at 11% over 6 years. Notice that I have also showed here the year. Take very careful note. Is it important? Is it kind of a waste of time to actually type in year 1, year 2, year 3, all the way up to year 6? It's not a waste of time because that number is an essential input in the formula here. You'll also see a shortcut in Microsoft Excel, which is that once you set a formula up, take all the time to get it right, know what you need to do to just copy it across. So you don't, instead of having to come up with six separate formulas, you set it up right for year 1, and then you copy it across. Setting it up, however, means there are some input cells here that we want to stay fixed. So for this loan, we're calculating the interest payments during each different year of the loan. This number will stay the same, the present value. The interest rate, the term, that will stay the same. You'll notice, what have I got here before each column letter and row number here? What do I have up here, if you can see that? Dollar signs. When you put a dollar sign in front of a column letter or a row number, that means keep it fixed. So here I'm showing it for year 2, and for year 2 it says I payment of D3, let's see, D3, that's the interest rate. That's going to stay the same for each year. Interest rate stays the same. Now E6, what is E6 up here? Anybody tell me, what does E6 refer to? Year 2, this year right here. That is an input cell. That's why I say set it up. If you set it up, it makes your life so much easier. This number is a specific input. It's going to change for each year of the life of the loan, as you'd expect. We have $D4, that is our number of periods. We also have $D2 for the loan amount, the principal balance, and then I put in 0 for the terminal balance. So here you will see that you set up the formula, then you put in the dollar signs at the appropriate place. You set it up for year 1. You get it right. Don't feel frustrated if you copy it a couple of times and you get error symbols and you have to go back and correct your work. That's how you learn to do it right. Make mistakes, correct the mistakes. You'll learn it much better than I could ever teach it. So here is what you would see in interest payments. Just a simple graph of saying if we show interest payment as a negative number, here's the interest payment for year 1, for year 2, 3, 4, 5, and 6. They decrease over the life of a loan as you expect. Here's my instructions to you on copying formulas. You'll save yourself a lot of time if you set up the formula correctly once and just magically copy it across. But to do so, you've got to find out which are the variables, the input variables to fix with dollar signs, which are the variables to allow to change. When copying and pasting a formula from one cell to another in MS Excel, if you do that, each of the input cell address row and column numbers will also change. If you want to prevent this, such as with an iPayment formula, insert the dollar sign before either the column letter or row number that you want to stay fixed. So here's your assignment. PPP project for a large, plans to borrow large loan to construct a new urban parking garage. The loan will be for $35 million. For a term of 8 years at an interest rate of 9%. Calculate each of the annual interest payments for all 8 years. Now that you're familiar with the techniques of PPP risk identification as well as financial statements, you can also test your knowledge on these subjects by completing the following series of exercises. I'll be introducing each assignment. You can pause the video, complete the assignment, and then restart the video and see how you did compared to how other learners did on the same assigned question. Congratulations on completing the assignment. We hope that this has helped you better understand the techniques of PPP risk identification, as well as how to analyze and prepare PPP financial statements.
Here are some takeaways from this module. We learned that risk assessment involves valuation, mitigation, and allocation. We must place a cost on risk, that is our valuation. We must lessen the impact of risk, that is our mitigation. And we must assign risk to the different parties, the public and the private parties. That is our allocation of risk.
I'd like to provide you with some additional takeaway points on this second module on PPP risk identification and financial statement analysis. The first is that to understand the financial feasibility of any PPP project, you can never rely on just one measure. You not only need to look at the cash flow analysis, you need to look at the income analysis as well. You not only need to look at the net present value, you also need to look at things like the internal rates of return, debt service coverage ratios, etc. Secondly, today I gave you an example of a simplified PPP financial model that all fits on one page. When you see actual PPP financial models prepared for real, complex projects, these are simply the same thing with a lot more detail. So when you see more complicated PPP financial models, don't be intimidated by their size. They're simply adding more detail to the same basic structure that we looked at on one single page. And then thirdly, for those of you that would like to improve your PPP financial modeling skills, the best way to learn is to try new things out, make mistakes, correct your mistakes, and to learn that way. For those of you that would like to improve your skills in PPP financial modeling, one of the best ways to do that is to simply try out new techniques on your own. make mistakes, correct your own mistakes, and you'll improve that way. I wish you the best of luck in improving your modeling skills. I'd like to thank you for joining us for this second module on PPP risk identification and financial statement analysis. We hope this helps you better understand how you analyze and prepare PPP financial models. We hope you'll join us for Module 3, in which we look at PPP credit enhancement techniques. Thank you.